Okay, so from my perspective, you got to use your scaling in and your leverage at the right places, like with a strong trend. Again, without a strong trend, we've all seen, the disastrous consequences of not going ahead and trading in with the trend. It's just that simple. So if you break your rules, if that's part of your rules and you break them and you take a loss, then, you get what you paid for there. Okay? Um, that's something to go ahead and keep in mind. If you break your rules and you lose money, you got nobody to blame but yourself. Just like me, when I lose money, you know, I just turn around and I go ahead and I focus on, well, like I said, look what I did wrong. This is what I did wrong. This is what I shouldn't have done. Here's what the rules are. Here's what the rules say. Don't break the rules. Okay. And granted, it's a lot easier said than done. Um, for me in particular, because you guys all have the advantage, the ability to come and go as you please all day long. In my case, I don't have that. I'm pretty much firmly planted here for the most part each day, because so many of you come and go throughout the day, based on your second careers and availability based on the kids and everything else. So, I try to be here, all throughout the day. So I'm kind of staring at this a lot longer. I don't get as many breaks. But if you are staring at this all throughout the day, you can start to find yourself trying to trade into things that you probably have no business doing if you really looked at your risk trading plan. And so we're trying to cut to the chase, and simplify that process. If it's if it's a strong trend to the downside and you're looking at doing shorts that meets your requirement, and you're looking at scaling in, well, there may be an opportunity there. If you're in a sideways market and you take a trade, shouldn't be scaling into it. You should go ahead and basically say, well, you know what? I knew the market was sideways. I tried to get cute. I tried to go ahead and take it and catch the low or catch this thinking it was going lower. I'm going to have to take the stop out. Or try to catch the long and it's pulling right back to the initial area. No surprise. Rob always tells me sideways market can whip right back, and Rob's shown that to me hundreds and hundreds of times. So, there should be no surprise, and rather than scaling, take the loss. Okay, that's my rule. And again, if I break that rule, that's where I lose money. And then the worst possible trade. So again, sideways trades can be taken, but without the scale-in factor. Okay. Then the last, and they should be done judiciously. And Glenn, like I said, I'll be showing you some scalping techniques for those, which I think increase the probabilities of success. Okay. Again, in a sideways market, I'm not looking for the big win because the expectation is it's going to blast off only to come right back to earth again, and then shoot down only to come back to earth again. That's what happens. The middle line here, earth, if you will, is it's everything's going to revolve around that and come back to it when you're in the middle of that non-trending environment. Okay. So I'm not looking for the big win. You're looking for scalping opportunities, which, like I said, 2 to 5 ticks can add up very quickly on the crude oil, can add up quickly on the currencies and so on and so forth. So, so we'll be talking about those strategies in an upcoming session here. The worst possible trade in all of this, and the worst possible scaling in, is the market's going down and you're trying to go long. This thing goes ahead and rolls back over, and you're scaling in, and you're scaling in, and you're scaling in. And against that trend, that's where I've watched most people blow out their accounts. So, counter trend trading and then getting themselves caught, and it just goes and goes and goes. Okay, even worse than the sideways markets. Okay, much worse than the sideways markets. When you're going against that trend and you're scaling in, that's where the ugliest things go ahead and happen. Okay, so only scale into a position in the direction of the trend, no scaling. That's my rule. See if that rule works for you. Check with your registered financial representative. Check with your risk trading plan. But that's it for me, because like I said, when I violate that, that's when I lose money. Okay, always like to go and emphasize that because it's a fact. So scaling in with no good 60-minute trend may allow you to scratch a trade, but it also increases the potential loss on the trade with 50-50 odds to start with. So from a risk management perspective, that's a lot of risk, to try to scratch out. So it's possible, if you're heavily capitalized, it's possible to do it, but it will develop bad habits going forward. And, so from my perspective, again, I think if you're looking at, no good trend on the trade, it's better just to say, well, I tried to get cute. I bought what I paid for, and, I lost. So I'm going to walk away with a little bit of dirt in my teeth, but at least I have all my teeth still there. They're not kicked in. Okay. The stronger the trends are across all time frames, again, the more aggressive I get with the scaling in, as I mentioned earlier. I scale in heavier at accumulation and distribution areas or support and resistance areas. And what I'm referring to there is the same kind of thing where if I went ahead and I took a trade, let's say down here, the next resistance level up is up here, and it goes ahead and happens to have like my key weekly levels up there as well, multiple moving averages. The more I get in there, and if it happens to be like a previous area of distribution back in the background here, okay, so if I can get those kind of confluences to happen, I'll get even more aggressive at those kind of areas, okay? So if, on say the 5-minute 20-period moving average, it does push back through that, but on the 15-minute chart, I've got the daily or monthly or weekly pivots. I've got my key weekly levels buried in there. I've got multiple moving averages coming through there. In the background, I have like a sign of distribution from a previous peak. Then what I'll go ahead and I'll do is look at getting more heavy in that area, expecting that to be the initial containment. Okay? So that's what I'm referring to there. The stronger the trends are, more aggressive, and also if I happen to have heavier signs of distribution or accumulation and support resistance in those areas, those will also inspire me to get more aggressive. Again, and like I said, I keep focusing on this theme, but so many people, don't do it properly. That's why I keep focusing on it. Scaling in only in the direction of the trend. With the 20-period moving average and the speed lines, if you have the 50 and the 200-period moving average, that's even better. So, if the hourly chart is going ahead and trending down, let's try it again. And you also have the 50 and the 200 coming down up there as well. Not necessarily right on the 60. That's great if it did. I mean, that confluence is awesome when you do. But if you just have them in the overall longer-term trends, and why is that? Well, because that's what a lot of the higher, the longer-term mutual averages, mutual funds and institutions that are playing for the long term and accumulating for the long term, and that's some of what they're focusing on. In fact, some institutions, their whole strategy involves taking a 50 and a 200-period moving average, and when the 50 crosses above it, they go long, and when the 50 crosses below it, they go short. Okay, or just the 200-period moving average. Other systems are designed wholly around the 200-period moving average. 200-period moving average is trending up. Price eventually breaks the 200-period moving average. They look at selling their positions. And vice versa. Price is going down. The moving average is going down. Price actually goes ahead and starts to break above the moving average. They look at start accumulating long positions. Okay, so if you could have things like the 50 and the 200-day moving average or period moving average, as it were, on an intraday basis, that it's that much better. Okay, whole systems, lots of people use 50 and 200-period moving averages. I like to look at what other people are using, and then I just use them a little bit differently. Okay, the speed lines cannot be going against the trade, that I want to get into. Okay, so if I want to go ahead and go short, I really don't want to go ahead and be getting short when all the speed lines are in an uptrend. Okay, and the moving averages, let's say, are in an uptrend. If things are starting to go into an uptrend, and I'm trying to short, those can go ahead and be resistance, in this case support to the trade, and can actually be something to bounce off. I just demonstrated that the other day when we had a healthy set of speed lines to the downside on multiple time frames in the same area, and that area the market came up to, turned around, and rolled right back over, even though we had a sign of accumulation from a VSA perspective. We had signs of accumulations right in the immediate background. It came up, smacked into my confluence of speed lines, and rolled right back over to the downside. Okay, so that's a real good example of that. Okay, I don't want the speed. If I'm looking to go long, I don't want those speed lines coming down on me. Okay, that's a no-win type situation for me, and vice versa. If I'm looking to go short. Okay. So the scaling in works better with a stronger 60-minute chart in place. Do not scale in if the trend is flat or against the trade. Could go against you easily. Again, I put this in there. The repetitiveness, I left it there because I'm trying to emphasize the point. Okay. Too many people are too hot to trade just in general. And I get that way every once in a while myself. I get myself a little, impetuous. I'm looking for the next trade. And that kind of thing. Like in my case, it's different for every person. For one person, they could be impetuous to get into a trade because they got in a fight with their spouse this morning. They've got a utility bill to pay, and they want money to pay the bill, and so they're like, you need to go make some money today. Okay, well, you're sitting there now with all this pressure on you to go ahead and make a trade. Okay. And so what happens is, well, that trade doesn't really look good, that trend doesn't look good, but man, my husband or my wife is going to go ahead and be torqued off at me if I don't go ahead and get this done, and do it properly right now. Well, guess what? What happens often, what's going to happen, right? This is what happens. You go ahead, you force into that trade because you're feeling these external pressures to take a trade, and next thing you know, now you've just lost money, hopefully not a lot of money, but you've lost money, and now you're even deeper in the hole. And then, of course, the next human reaction is, I got to dig myself out of both of these holes now. The money for the utility bill and the money I just lost, okay? And it becomes a self-fulfilling prophecy of damage and disrepair, okay? That's why when I go ahead and I take a loss, I go ahead and I reevaluate, what did I do wrong? What do I need to do better? Where's my head at? Am I in the right mind to take the trade? And then, of course, do I have any sort of external pressure causing me to feel like I have to trade, which sometimes this room has been my external pressure. There's been times where I get these Norman new guy and new lady traders that are like, come on, you know what? Get me my next trade. Okay, that last trade was great, but get me another one. Get me another one. And what most people don't realize is there's several low probability trades during the day, but very few high probability trades each day, okay? And so what happens is it puts this external pressure on, and I'll never forget, here's a great example of this. Many of you that have been with me for a long time already know this story, but Gavin and I were in Los Angeles together at the Traders Expo last June, okay? And for those of you from the VSA side of things, I don't know if you heard this from Gavin as well, but we've talked about it in the past. Gavin and I were there, and for like literally an hour and 15 minutes, it was like the most painful hour and 15 minutes of my life, because I went ahead and I told Gavin, hey, I've got all these prepared slides, and he's like, no, let's just go without slides, let's kind of wing it, we'll just trade it. Well, wouldn't you know it, the market for that hour and 15 minutes was like in a 1-point range on the S&Ps. It was like a 1 to 1.25 point range. It was just ungodly. It was an unsightly mess, the worst possible condition, of course, to do a live trading event in. And because I didn't bring my live slides, because, Gavin taught me out of it, said let's wing it, we basically just did just that. We wung it. Well, at one point we asked the audience, hey, who sees a trade here? Okay, does anybody see a trade? Well, 99% of the people are all shaking their heads saying no, there's no trade here. Well, one guy who's sitting kind of close to the front goes ahead and right in the middle, right in front of us, starts saying, well, yeah, you should have gone ahead and channel traded that thing. Look at how much money you could have made. Now, keep in mind, this was a 1 point to 1.25 point range. So if you keep in mind the bids and the offers, how hard that would have been to channel trade that thing in the first place, okay? But then on top of it, to add insult to injury, what happened was I challenged him on it because what he was saying just didn't, make sense, because he just, it was like he was speaking more for the audience's benefit versus actually asking a question. It was kind of like he was very verbose and just wanted to hear himself talk and impress people. So I kind of challenged him on that. And we'll come to find out by the time we were done, and I was interrogating him back, if you will, what happened was he ended up admitting right there in public. Gavin, was right there to affirm it. He was right there with me. The guy ended up admitting he lost 75% of his capital using that strategy. Okay? Now, this is a very real world situation. Every once in a while, I'll get a new trader that comes in here, talks a big game, tells me how, I should go ahead and trade. And, just like this guy did that day, telling me how I should go ahead and trade, and come to find out he had lost 75% of his capital, okay? And so, it's as I've said many, many years, I've been trading long before most traders have ever thought about being traders, and I'll trade long after most of these traders are gone. Kind of reminds me of the guy I told you guys about from months ago in this room that we're here, who kept, counter trend trading, being very verbose and getting a lot of attention in the room, having messages sent to him, hey, how did you do that? How are you doing that? Man, your system is awesome. And in reality, the truth of the matter is he was trading on a simulator. And once he went ahead and moved to real money, he blew up and was out of the game and had to go back to, his regular day job stuff, which was working at a wine place out in California. And but boy, he talked a big game, and just like this guy did with Gavin and I back in, L.A. last year. So the point being is that people come under pressures, and people will try to talk you into taking trades. And in some cases, they'll even go ahead and, like I said, present themselves as a resident expert. And then, next thing you know, you're in a world of hurt. And so just keep that in mind, that if it doesn't meet these rules, these are my rules, okay? But if any of these rules make sense to you, okay, then maybe you need to go ahead and see if you can incorporate them into your risk trading plan for the ones that make sense to you and your registered financial representative agree on, okay? And that's kind of my point here, all right? Let's see, where did we go ahead and leave off here? Okay, scaling in considerations. If the 30-minute and the 60-minute are good, if not, I'm going to be less aggressive with the scaling. And it also depends on how much the market has already moved and where is the support resistance. Okay, so there's a lot of factors that are going into that simultaneously. All right, how good is the quality of the trends that we're trading? Okay, the 60 and the 30-minute trends. Okay, are they starting to bow out? Are they starting to flatten out? They were good, but you're in the trade now. You've been in the trade for 15, 20 minutes, or 30 minutes, or an hour waiting for it to work. And the trade's still not really working, but now the moving averages are starting to flatten out a little bit, so is quality deteriorating? How far above you, like if you're shorting, this is an example of shorting. If I'm looking at shorting, how far above me is my resistance, okay, will determine how aggressive, I can be. So those are a couple of the factors there. And also, how far, again, is this market already moved? I mean, have we moved 5, 6, 8, 10 points on the S&Ps, and I got my resistance 3 points or more above? Well, I'm just asking to go ahead and have to get into a major scaling situation there, because we want to expect snapbacks, especially if the trend is starting to straighten out here. We want to expect snapbacks, and even if it's just a normal snapback, if we're 3 points away, 2 points, 3 points away from the next resistance level back to the upside, we have to assume that the market is going to go all the way back up to at least that point, if not higher. So you have to be prepared to take that kind of heat, or you just scratch the trade, or you never find yourself in that trade in the first place. Okay? All right, so here's just an example of some of my like S&P trading. Sometimes you'll see me if I got a strong trend, I'm maybe put 10 contracts in at the first support level, and then I'll scale in 20 or 30 contracts at a more stronger resistance level above. Okay, that's just an example. But you know what? You could just as easily forget all that for a minute. Some people always get hung up on the numbers. Again, I think that's a junior analyst, junior trader mistake. Go ahead, just gray this out right here or blacken it out. And it could just as easily be one contract initially, 2 or 3 contracts, above. Again, traders have gone ahead and watched me here trade, 50, 100, 150 S&P contracts, okay, and make a lot of money with that, okay? But forget all that for a minute. Just see what I'm talking about here. It could just as easily equate to one contract at the first support or resistance level, depending on what, which side of the trade you're on, 2 contracts or 3 contracts at a more major area of support resistance, okay? So, those are just some examples of, how I do it. Obviously, I'm, typically looking at larger numbers, but we'll also trade smaller numbers too to show people of all, calibers how it can be done. Some people just can't wrap their head around the axle and understand that whether it's 10 contracts, 20 or 30, or 1, 2, or 3, the concept is still the same. It's just math. Okay. So then from there, I'm looking at adding contracts at a point, 1 point intervals above that. Again, that's assuming, these trends are close to each other and strong. Okay. So this is, let's say, the 5-minute moving average. Got a contract in there. This is the 15-minute, 20-period moving average, and I've got 2 or 3 in there. Then if I happen to have a level above that, like the hourly chart and or several other key support or resistance levels, then I'll go ahead and those are within approximately a point or so of here, then I'll go ahead and I'll look at getting in there. But otherwise, if it's, let's say, 3 points above, I gotta go 3 points to get up to there, then I'm going to hold my ammunition until I get up a little bit closer there. Okay, so the key is that, we're in a strong downtrend or uptrends, strong trend, and I'm basically trading against pullbacks that are near very strong support or resistance levels. That's very key here. It's something that so many people miss. Okay, just like that trade I did this morning, I waited till it got right up to my resistance level. I had the stop in there, the entry price in there already. The market did come up there. It took me into the trade, and then it pulled back. But it was right up there, right at the congestion that I identified for all of you before I took the trade. Okay? And again, this whole concept of scaling, for those of you that don't feel comfortable scaling, don't do it. Okay? If it doesn't meet your risk trading plan or what you and your registered financial representative have set forth, don't do it. Okay? You just have to be much smarter about your entries. From my perspective, that means you really need to focus on what I was sharing earlier with trends, trying to enter trends much closer to the, if you're shorting, resistance lines. If you're going long, much closer to the support lines. And then if it doesn't go your way, well, suck it up. You get stopped out, and you have to move on. Okay? But if you got a strong trend, and you see, okay, well, maybe I was just a little bit early on this, but the trend is still very much in place, I am willing to scale in a little bit back, then there's an opportunity there. And that's a good point. What happens is, Glenn says, I get blinded when I scale. Makes me deny the reality of the market moving against me. Well, okay, if we're talking about a real trend, not sure how that happened. Let's try that again. Okay, if we're talking about a real solid trend, you got daily charts, you got weekly charts, you got hourly charts going your direction. Okay, the thing is, even within a strong uptrend, you're going to go ahead and have pullbacks as it rallies, right? So the key is then as you're looking at the 15 and the 30-minute, the 5-minute charts, if you get in, even let's say at the 5-minute chart, sometimes you've got to pull back to the 15-minute chart before it resumes. Or you try to get in at a speed line, which is a technique I'll demonstrate in the future, and it goes ahead and actually drops to the 5-minute before it goes ahead and rallies, okay? Just because it's pulling back a little bit does not mean the market's actually going, that the whole trend has changed, okay? That's a lot different scenario, though, right there, Glenn. But if you're blinded because of size, and that's just whatever you do, forget scaling for a minute, just general entries, Glenn. And so let's just talk about that. It's not on this slide, but let's just talk about it. If you put one contract in the market and you're comfortable, you almost have kind of a quote-unquote don't care attitude, what's going to happen to it, that's good. If you have 2 contracts and you don't care, that's good. If you have 3 contracts and suddenly you're freaking out, your hands are sweaty, your palms are, you're freaking out, you're calling like 6 different people for, to come bring you, tranquilizers because you are just going off the reservation, freaking out, well then, I can't trade 3 contracts. I need to be looking at 2 contracts or less, okay? And I see you laughing there, Glenn, but it's true. It's true. What people have to find out is what's their tolerance. Me, I'll trade 50 or 100 contracts. I'm a professional trader. I've been doing this for many years, okay? I've been trading for years. I have no problem slinging around 50 or 100, 150 contracts, okay? But I've also been doing this for a long time, and this is what I'm doing. This is my full-time, position here, my full-time job, if you will, okay? So that's a lot different than a junior trader walking in the door because they fired their boss and they said, you know what, I'm quitting my job. I'm going to go, do what those advertisements say, and I'm going to go quit my job and be Joe Cool or Jane Cool super trader, okay? Or you get laid off, you get a severance package. I had that happen. I had a guy call me. He got laid off. He had a severance package, and he said, I want to become a day trader. I want to sign up with you. And, I told him that I felt that this may not be the best environment for him because, I need somebody who's serious and committed and has the time and the learning ability to go ahead and become a professional trader, not somebody who's looking to get rich overnight because they got fired from their job and they got a few bucks in their pocket, okay? And so, so what I'm saying there is, each person's going to go ahead and be different. And what hopefully will happen for every trader here will hopefully be that over time you're going ahead and able to trade more and more. So instead of making, whatever, it doesn't matter. You're making 5 ticks on a euro trade. Instead of doing it with 1 contract, which means you're going ahead and making $62.50, hopefully what's going to happen is eventually you'll get comfortable as you're growing, you're confident, you're following your rules, you'll get confident, you'll be able to take a 10-contract trade at that level. Now suddenly the same profit is $625. Okay, does that make sense? So the key is you're supposed to be working towards, your math, being able to grow in confidence and trading ability to be able to trade more. If your goal in life is to make, millions of dollars off your 1 or 2 contracts, well, I've been known to burst bubbles before. I'm going to be here to burst your bubble. Okay, because basically what you're going to have to do is be trading in and trading out of the market all day long, and with the commissions, even on the S&P, let alone the euro, you're going to go ahead and be fighting an uphill battle, because between commissions and then losses, it's a challenge. Okay, so the goal is to get good, get proficient, get a good solid set of rules that you feel comfortable with, you and your registered financial representative have signed off on,